There we go. Fantastic. We're going to review some of the management ideas for Bull Call debits and the stock repair tool, or what's known as income method number 5. Max had sent me an email earlier asking, is it possible to go deeper analyzing rolling in both ups and downs for Bull Call debit spreads, where we sell an at or slightly in the money call and buy a deeper in the money call for a debit. As long as the stock stays above both strike prices, we make the full profit and we can move on. And a call ratio spread plus stock. Sorry about the image there, it didn't turn out. This would be a stock repair position. Where I have a stock that's down, I can use a stock repair tool on power options. If I have 100 shares, I'll look to sell 2 out of the money calls and buy a lower strike call at a credit. Essentially, I have a covered call and a Bull Call debit spread that I receive a credit for to help me get back to break even faster. The call ratio spread is also used in the married put structure, income method number 5. It's the same as a stock repair. It's a ratio call spread, but it's done inside the protected married put position to potentially enhance profits of just selling the call that we looked at a little moment ago. Now, we will review the concept. My initial response was there's already full content on these topics. For the Bull Call debit spread, go to the YouTube channel and click on playlists. Click the link for the Bull Call debit spread playlist, and you'll see 3 very important webinars on this topic. Stops on debit spreads. What to look for is when to stop the position. 7 ways to manage a Bull Call debit spread, and ideas on rolling a successful Bull Call debit spread for more profit or to lower potential risk in the case of the reverse. Regarding the income method number 5 or the stock repair, essentially they're the same structure as I mentioned. But as a Blueprint owner, you can log on to radioactivetrading.com, access the members only content, the Blueprint owners only webinar section, and there's a link there for 5 ways to manage income method number 5, which is the same as 5 ways to manage the stock repair. But let's take a look. Let's review real quick, managing a Bull Call debit spread. A review of the stops. I entered a position that I'm bullish on. Here on August 15th, Starbucks was trading at 89.16. I could have sold to open a 26th of August, next week's expiration, 87 call for $2.95, and bought a 26 August 85 call for $4.60. The net debit would have been $165. As long as the stock is above 87, I essentially buy shares of stock at 85, sell them at 87. I get $2 back, so I have a max profit of 35 cents off of my investment of $165. I would have opened this position because the stock was trading in an uptrend above the 20-day moving average, MACD was positive, the technicals and fundamentals matched what I'd look for a neutral to bullish position. But now the stock's at 87.06. I'll look to manage the position or potentially close. If the stock was within 1% of our sold call strike price, same as the credit spread. If the sentiment has changed, there's negative technicals or negative fundamentals now as well. And if my spread has hit 50% of that maximum loss. In other words, if I liquidate it and the liquidation loss is 82 cents, that's half of the maximum loss of 165 I could lose if the stock was trading below both strike prices. I'm not going to allow it to go more than that. In this brief example, it hit the 1% rule. The MACD went negative here. It just showed a little bit of a negative cross today as it went down, but it's still above the 20-day moving average, and I'm not at the 50% loss yet. But I may still consider management. What are the 7 ways we might manage a Bull Call debit spread? Number 1, do nothing. Wait to see if the stock recovers, and this is just a hiccup in the market. I'm not at my 50% loss yet. I still have a week to go. Am I risking keeping it open over the weekend in case news comes out and the market opens down on Monday? Absolutely, but we'll look to it then. Number 2, liquidate the position. It's not doing what I expected. It's starting to move against me. Take the small loss, find a new trade that is matching my sentiment in the current market conditions. Management 3, roll down the short option only. This is one of the reasons why I like to keep a strike difference between the 2 strikes in any spread position. We had sold the 87 call and bought the 85. What I may do is buy to close the 26th of August 87 call at 115 and sell, same expiration if I have more than 4 or 5 days to go, the lower strike call, in this case the 86, which I could get $1.84 for at this time. It's slightly deeper in the money. The original bought 85 call is not touched. We're just rolling down the short option. As you can see here, we gain about 70 cents in premium from closing at 115 and selling a new one at 184, but we also give up $1 in the strike difference of the spread. Instead of having a 2-point spread where we get 2 points back, we only have a $1 strike difference now. The max profit anytime you do this adjustment, as well as some others we're going to look at, is going to be lowered. Why would I do this if I wasn't at the 50% loss? And the idea is to give myself a little bit more protection, because in this case, the stock kept falling and it was below my sold call strike price at 87. And it also gives me a better probability that the stock might remain above that lower strike call and I can still make some profit on the position. Not a lot. I don't think this would be worth it in this case, but I'm just using it as an example of what rolling down the short would look like. Management 4, roll the whole spread out and down. We liquidate the existing position. We take the loss on the trade. We find a new spread a week or 2 weeks out in time that covers the loss and the new net debit to get me back to profitability. To get to a reasonable profit, this will likely involve increasing the strike width or adding more contracts. Instead of, if I originally did 1 contract, I might be doing 3 contracts or 4 to get the monetary profit up. Or instead of doing a 2-point spread, I might be doing a 4 or a 6-point spread to try to get the larger return between the strikes if everything works out the way I want to. Now, this spread here is showing us a September 2nd, 85 call sold for $2.99 and an 83 call bought for $4.55, a debit of $1.56 for a potential profit of 44 cents. But the liquidation loss on the original spread was 32, so this puts us at a maximum profit 14 days from now of only 8 cents. Very similar to that small return we just saw with rolling down the short leg and keeping the same expiration. To get the higher return, I'd have to increase the strikes or increase the number of contracts to see more monetary profit, in this case, factoring in the loss we took by closing the initial spread. And Max said, sent me a follow-up email, and he says, well, you had mentioned that you close the spread when it's at a 50% loss. Could you still roll that spread down and out in that scenario for a bull call debit? The answer is yes, but I'd like, with a 50% loss, remember I'm losing 80 cents. It would have been half. Let's go back up one, I'm sorry. Losing half of that value, Max. I'm sorry, that's the different one. There we go. I'm sorry, folks. I lose 80 cents, but most of my positions, I'm looking for this type of return of 35 cents or so. So I've wiped out 2.5 trades roughly. I'm not going to see an 85-cent profit on the type of debit spread I'd want to use with the same range in the money. If my normal one is 35, what do I have to do? I have to go out further in time, maybe 2 to 3 months. And to see 85 cents, I'm probably going to have to double the contract size. We're talking monetarily, not straight profit. You're going to have to double, triple the contract size or increase the width. And as we all know, when you double the contract size, you increase the width in any spread position, what is it going to do? It's going to increase the potential for loss, much higher losses if the stock continues to move against you. All right, so management number 5, create a condor or a butterfly. Add a bear put debit spread out of the money with the same expiration. This moves your upper and lower break even further out. But yes, now you do have an upper break even. You could lose 2 ways. You could also add the bear put debit spread with the same sold strike. I'd add a bear put by selling the 87 and buying the 89, same strike difference. That would create this butterfly position on the bottom right-hand corner. We increase the break-evens, but we can now have 2 break-evens in this position. We can still lose on both. What I mean by that is you can still lose on both converting to a condor or a butterfly. If the stock recovers and moves back up, you could lose on the bear put side now. If it continues down, we're still going to be losing on the bull call side, just maybe not as much. The risk is reduced because you would lose on one, but then you'd also win on one as well. Management 6 and 7. Management 6, close the spread. In this case, we would have taken that 32-cent liquidation loss and open a bear put debit spread further out. Similar to the management of income method number 4, rolling down and out, but now we're changing the entire sentiment of the trade because our sentiment for the position has changed. We now think it's a bearish stock, not a bullish stock. Once my sentiments change, I don't want to keep rolling down my cash secured naked puts or my covered calls or my bull call debits. I either want to go into a new stock that's matching what I want for that trade, or I need to convert to the sentiment on that stock that's currently matching. And management number 7 is a pendulum adjustment. This is usually done if the stock is between the strike prices. Remember, we had the 85 call bought and we sold the 87. If it's available, what I'm going to do is sell to close my 85 call, swing it out and buy a higher strike 89 call, 2 strikes away from the pivot, the 87 strike. With one move, we turn the bull call debit into a bear call credit spread, which is going to still potentially be profitable, but probably less of a profit, just like management number 4, than it was on the original trade. But if it keeps going down, I now have a successful bear call credit spread instead of losing more on the bull call debit. So, more in-depth analysis is in the full videos, additional pros and cons of each one of those management techniques, when to consider each adjustment, other thoughts on the usefulness of those adjustments, and also check out the rolling a successful bull call debit spread as well to see what ideas are available there to roll the bull calls in that case. On to the ratio call spread, the stock repair or income method number 5 in the married put structure. Ratio call spread. Again, buy a slightly in the money call and sell 2 times as many at or out of the money calls on the position. It's essentially a bull call debit spread with a naked call, but done in the context of owning the stock or in the married put structure. It's really just a bull call debit with an extra covered call that we receive at a credit. In this example, we're taking it never hit this, but if I had bought Starbucks at $92 and it's down now to 87 or so, 5-point loss on the position, I saw a potential stock repair 35 days out where we could sell 2 September 23rd, 89 calls for 216, so we're going to get 432, and we're going to buy an 86 call for 385. So we're only going to get a debit here of about 50 cents, 48 cents really in this case. I'm sorry, a credit. I want to do this at a credit if possible. But my break even has lowered now from $92 to $88.77. Why? Because if the stock starts to recover, I'm gaining value on the long call that I essentially received at a credit, and I'm gaining back on the stock so I can get to break even faster in this scenario. I have an obligation to deliver my shares of stock here with 1 sold call, and then the other portion would be that profitable bull call debit spread if everything works out the way that I want. So what about the management? Well, it's kind of simple to look at, isn't it? I think it is, but that's why I'm here, to help you if it's not. If the stock is above both strike prices, why they're in an income method number 5 with the stock repair, it did what you wanted to. Let the stock be assigned. Take full profit on the debit spread and close the long put if it's a married put. If I was in my long stock, I'm back to break even with the stock only being around 88.70 or 88.80. I didn't need it to go back up to 92. I've made a small profit on the position. That's what I want to see. If I feel more comfortable with the stock now, what would I do? Well, I'd roll one of the sold calls, just as I would with a covered call position. The stock's above my strike price at 89, going up to 90. I want to stay into it. I'll roll the covered call as I regularly would, and then I'll close out the bull call debit spread portion for near the full profit and continue the trade. Of course, I also consider if I like this adjustment and I have a target for where the stock's going to be, I could close out all 3 legs of the repair, the income method number 5, and move it up and out to another income method number 5 position, taking the profit on the bull call debit, rolling the call that might be done at a debit as the covered call portion, and just opening a new ratio call spread. Stock is between the strike prices. What's going to happen? Well, the sold calls expire worthless. You have no obligation to deliver anything. The long call may still have some intrinsic value to it, which could help lower the cost basis on the position. What are my options? Well, in this case, when it's between the strikes, I can close one of the sold calls and close the long. Essentially, I'm liquidating the bull call debit spread for whatever value I could get. This also avoids me forgetting about it, leaving it open. If the in-the-money long call is still there, even though the short calls expire, my broker will assume I want to exercise it. I'll have another 100 shares of stock. Is that what I wanted to do? If it helps me average down, maybe, maybe not. but that is an option that you would consider. Number 2, of course, just like rebracketing a collar, standard collar position, if the stock is between both strikes and your out of the money call and out of the money put expire worthless, you could close all legs and just roll out the entire spread. Rebracket with another income method number 5. If it's a married put, if it's a married put, you could consider using a different income method. What else to consider here if the stock is between the strike prices? Well, we just spent 7 ways of managing a bull call debit spread. We could apply one of those to the losing situation of a bull call debit spread. Maybe I could do the pendulum adjustment in this case and turn it to a bearish position. Probably wouldn't do that though while staying in the stock, simply because I'm going to lose more on the stock if it keeps going down, even though that new bear call or bear put would be profitable if I rolled into the opposite or did the pendulum adjustment. But you could apply those bull call managements absolutely as well. And lastly, the stock is below both strike prices. The stock continued to decline and we're realizing further losses. We could let the options expire, of course, now it's below all 3 legs, and evaluate if a new repair is possible using the stock repair tool and power options. We could manage the bull call side as outlined, as we discussed, the pendulum, close and do the opposite, roll down and out, or manage the covered call in that same situation as you would in a stock that's declining. Third option, not as attractive, but it has to be discussed. Your stock fell. You did a stock repair. The stock continued to move down. It's not doing what you want. You could liquidate everything. The stock is not performing. Avoid further losses, because even with rolling down covered calls, rolling down the stock repair, unless the stock moves back up, you're just going to continue to compound losses. It's better to cut the losses short. Don't let them get too big. Don't hold and hope with doing different adjustments in this case. Get out of it. Find a better stock that matches the sentiment you're looking for the strategy you're looking for as well. Further insight, of course, are in the Blueprint Owners webinars. As I mentioned, log on to the members account at Radioactive Trading if you're a Blueprint owner. Click the members, Blueprint Owners Only webinars, You'll see that full presentation there. 5 ways to manage income method number 5 and other topics on income method number 5 and the other income methods as well.